Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. While we speak of inflation and debt ceiling, in equities, there is one stock that's increasingly getting inflated and shattering the ceilings. That's Nvidia, the chip manufacturer. Its market valuation fleetingly crossed the $1 trillion mark, temporarily joining the elite trillion club, which consists of only five companies. All of this is after the management provided an AI fueled sales forecast that shattered Wall Street estimates. Meanwhile, a lot of data from US economy is due this week. Remember, a stronger economy will postpone the narrative of Fed pivot, which the market is expecting, ideally leading to some dollar strength and vice versa in case of weak numbers. Good morning, JK. Take us through your thoughts on the markets and what's grabbing your attention.
Good morning, Swaraj. So as the market returned from holidays for the major economies like UK and US, I've seen some significant moves in the yields particularly. In fact, they have reacted late to the US debt deal uh, with, with the reason because of the big markets being closed. And on Tuesday, we saw the two-year yield down to 4.465%. 10-year to 3.696 and 30-year to 3.90%. And they have moved 10, 17, and 30 BPs respectively. Rather, 2 years have come down by 18 BPs, 10-year by 17 BPs, and 30-year by 11 BPs. And these are very significant moves. And these were also held by some sober data from US and also fall in inflation in the Spanish economy, apart from expectation that the Eurozone inflation, which will be announced tomorrow, will also fall sizably. It's also happening despite the increased chances of another rate hike in June or July by the Fed, which means that the rate hike is already been discounted. The combined effect of a debt deal and the fall in European inflation has also seen German 10-year yield fall by a whopping 22 basis points and 2-year by 18 basis points. And in fact, stocks had already moved on Friday. Perhaps they had anticipated a deal coming through, but it was the treasuries that really moved yesterday after the UK and US traders came back from their long weekend. So we did see a consolidation in stock market yesterday. Now, what was also significant was that the data across US and Europe were quite weak yesterday. On the US side, we had the conference sports consumer confidence index, which was which came lower at 102.3 versus 103.7 in April. And importantly, the expectation index, which measures the short-term outlook for economic, business and labor conditions, fell, and this index has been holding at 80, below 80 rather, every month since February 22, except for December. And it's pointed out by the conference board that 80 is the level that is associated with the recession coming within a year. And also we had, the Dallas Fed Manufacturing Index with, in the Texas region, which is one of the most closely followed regional indicator for manufacturing, dropped to minus 29.1 from a reading of plus 5.7 last month, with most of the components recording decrease. And Texas is an important region for US economy's manufacturing output, ranking second only to California, and also the first largest exporter of manufactured goods from the US. Hence, the broad-based decline in this index is really of concern. On the European side, of course, Spanish inflation, including core inflation, fell sizably, while the economic survey on the region also increased the concerns about the growth in Eurozone. So these soft data and also the fall in inflation in Eurozone, in fact, giving some sort of a relief for the policymakers in Europe, possibly to think about a pause not very far from now, although we should expect a definite rate hike in June and possibly one more in July, but maybe not beyond that. So in these expectations, Euro actually has been under pressure. In fact, we saw it breaking 1.07 yesterday, and traded down to 1.0670, but bounced back after the US data came weaker as well. And overall, we saw the dollar index itself has been holding somewhat stable to weak, stable to strong rather. But what this currency which has been standing out has been the Japanese yen, which has got increased attention from the policymakers who have been sounding out alarm bells for the yen sellers, saying that they are watching the market and they would be in fact taking appropriate actions or some response to the weakening yen, which is hit the softest point in 6 months versus the dollar. And in fact, there has been a talk of some emergency meeting among the policymakers to address this yen. What stands out is that there may be a possible snap election in Japan, and if the Prime Minister wants to address the source of energy inflation, which has been keeping the overall inflation high, he would probably looking at the currency depreciation, which has been contributing to it. So the many factors are building into yen strength, and of course the yields falling in the US yesterday, as well as the Europe zone inflation falling, leading to fall in yields across Spain, Germany, and other countries, also might be contributing to yen strengthening. So in any case, yen has been the weakest of the major currencies, and some sort of a strength in this currency, with or without the authorities touching the monetary policy, is quite likely. So on the Chinese side, which is the other weak currency against the US dollar, once again we had another weak number from China today, particularly on the manufacturing PMI, which continues to be not only in the contraction side, but also well below the expectation. Although services side is holding above expansion in the expansion territory, it still is well below the expectations. So overall, while we have mixed data from US, we are having a steady stream of negative or rather weak data from Europe, and that actually is leading to strength in the dollar index, and euro possibly leading the weakness in the weakness in the currencies. Of course, we did have a big fall in the oil price also yesterday, falling almost 4%, even as traders are awaiting the outcome of policy, outcome of a meeting of OPEC plus countries. The prices came lower also because data from US and Europe were quite weak. And if only thing they are watching is the warning from the Saudi authorities about excessive speculation. However, if there is no action to cut production, I think possibly we may see some more downtick in the oil prices. Definitely, stock markets were very subdued yesterday. As you said, it's only the AI stocks which are receiving more attention, but even there, we could see some profit taking hitting the market. One thing about the AI stocks is that it's grabbing a lot of attention from the policymakers, and that could be probably the reason why one should be looking out for a lot of choppy action in the related stocks. On the rupee, it's definitely playing along with the dollar index and the movement in the yuan, but in a much narrower range than these currencies. Forward hitting a 15-month low yesterday, not really encouraging for short sellers of the dollar. In fact, while we have seen the largest inflow from FIS for FIS for more than 10 months at 5 billion in May, has had no impact on the rupee to strengthen because of the policy of the central bank to absorb most of the inflows. And what we see, what we are carrying is a slight bearish bias for the rupee, and a break of 80 to 85 could test 83, particularly if we see a sustained break of euro below 1.07 and Chinese yuan towards 7.12. So the production cuts announced by OPEC and its allies, which is having limited impact on the prices, might be helpful to the rupee, but not to the same extent as one would expect, because the lower trade deficit, current account deficit has already been discounted by the market. So central bank is the one to watch out as far as the rupee is concerned. Thank you.
Thank you, JK. And just to quickly summarize, we had the Spanish inflation falling sharply yesterday, and now it is expected that even the Eurozone inflation, which is due to be released tomorrow, will fall. There was significant movement in yields after the long weekend, which reacted somewhat late to the debt ceiling news. While data across US and Europe were weak, US consumer confidence index came in lower. The short-term outlook for the economy fell as well, and the Dallas Manufacturing Index as well. Uh, all of this combined with the fact that there is weak data coming in even from Europe. Uh, Plays into the entire dollar narrative because it's all relative in the world of currencies. Whose words will determine the currency direction? While for rupee, we are playing along with the dollar index and the movement in yuan. Despite FII flows, as of now, there seems to be no strength in rupee. That's it from us today. Tune in tomorrow for another round of fresh updates. Thank you so much for listening.